Hello and welcome to the Money Show, where we break down everything you need to know about personal finance and wealth building. I'm your host, Kavita Thaplial, and today's episode, we'll dive into latest trends, tips and strategies to help you manage, grow and protect your money, whether you are looking to invest smarter, plan for retirement, or just make better everyday financial decisions. We've got you covered over there. Every week, we bring in experts from the world of finance, investing, and economics to answer your burning questions and guide you through the often complicated world of personal finance. We help you with tips to grow your savings, understand the stock market, and avoid common money-making mistakes that could be holding you back from financial goals. The right kind of insurance for you, be it loan repayment strategy or any other financial goal-related strategy. So let's get started. And before we begin, just in case you want to send across your queries, you can do that on our WhatsApp number, which is 865-797-4571. We also have an email ID, which is themoneyshow@etnow.tv. Okay, so let's begin, and we are diving into a crucial topic that's dominating the financial world today, April 7, 2025, the mayhem in the Indian market as global investors react to the latest news surrounding US President Donald Trump proposed reciprocal tariff. Now, to help us understand the market's sharp reaction and its impact on India's economy, now we are joined by highly respected Aashish Somaiyaa, CEO, White Oak Capital AMC, a leading voice in the market analysis and investment strategies. Aashish, good evening and welcome to the show. Thank you so much for taking time out. You know, a very crucial phase for our investors, and we definitely need a lot of hand-holding from you. So, uncertain times, clearly, but I really want to begin with the question, which is the word of caution that should be coming from you around Indian markets, especially, where, we are seeing times, or maybe you can tell us the times of 2008 or 2020. Do you see us repeating that? Is it the same kind of phase that we are looking at? Should we be bracing for more volatility? What do you think?
So thanks for having me, Kavita. It's a good day, not from market perspective, but definitely a good day to be in front of investors and talking to all of you. I think we should brace for more volatility. I have no doubt. But should I compare it to as much of panic as it was in 2020? I don't think so. The reason is because the market has got a very, very long time to adjust. Right from September or October onwards, we saw that the Nifty made a peak in September 2024. From that point onwards, there was some news that Mr. Trump might win. And obviously, slowly, the expectation set in that if he wins, then how it would be disruptive. And then, of course, on 2nd April, when he announced the tariffs, which were always expected, that he has a different worldview. When he has been putting forth the view that the American consumer for far too long has been the source of wealth creation, first in Germany, then in Japan, then in China, and then, Vietnam and other Asian countries. And of course, at some point in time, maybe even India. So he feels, their worldview now is that the American consumer is the source of strength and source of growth for large parts of the world. So why is it that America is buying everything from everybody, but everybody else is not buying enough from America? And then you also saw, the confrontation with Ukraine, whereas their belief is that the American taxpayer is footing the bills for NATO and for security of Europe, whereas Europe itself is not doing enough. So I think that there is, some changes being caused in the way the world is supposed to work or the way the world is expected to work. And that is causing a lot of volatility. I would just say that India is witnessing more a global collateral damage. I don't think this is anything to do directly or necessarily with India. We are not the biggest source of trade imbalance for America. In fact, in the longer term, I would expect India to get opportunity out of what is happening. But in the short term, yes, we have to brace for more volatility, nothing to do with India. In fact, in India, the domestic conditions are improving. And if there is some trouble in the world, globally interest rates coming down, the dollar depreciating, none of this can be bad news for us. I think medium term to long term, everything is good news for us. But when the world is, a bit of, it's going through a bit of change, a dramatic change, then we need to be just cautious for a couple of months, because I wouldn't be surprised if this continues for a few more weeks.
All right, so in short term, turbulent times. But then let's focus on the part where you mentioned that this is a global collateral damage that India is also facing. Otherwise, we are very strong on a domestic front. You know, in this entire scenario, I also want you to elaborate and or maybe decipher the positives that we might see for India as far as money flow is concerned, as far as the liquidity part is concerned. You know, the weakening dollar scenario, interest rate cut, and especially commodity prices coming down, Ashish. How
Yeah.
should we be looking at this? Does the tariff hit here looks big, which might not in turn be, so big, because I'm sure there'll
Yeah.
be negotiation between New Delhi and White House as well. So as compared to other countries, I think there's a lot of positive also.
Yeah. So, starting with the last part you mentioned about comparing with other countries. See, we are, like I said in my opening remarks, we are not the biggest source of trade imbalance for America. And even before all of this started, I think our government and our commerce ministry has been probably a bit proactive, whereby already a bilateral agreement has been in the works, right? I think as soon as Mr. Trump became president, there were talks about Tesla coming back into, trying to set up base in India. There were talks about India cutting import duties. There have already been a flurry of negotiations on the bilateral side. So definitely we are not a thorn in their flesh, or definitely not the biggest thorn in their flesh. I think the challenges are more related to a huge trade imbalance with China and with parts of the European Union. And unfortunately, some of these large geographies of the world, first Mr. Trump has put reciprocal tariff, and then these guys have put retaliatory tariff. And I think today the way the market has behaved has got more to do with that rather than anything else. That you can just imagine that if this tariff over tariff, if this kind of stuff is happening, you can imagine that in the next 7 to 10 days, pretty much some part of trade will just come to a grinding halt, because something, if it was costing $100, if it's going to start costing 130, 140, or 150, the buyer is not going to pay the entire difference, and the seller is not going to give a discount on the entire difference. So somewhere the matter needs to get sorted. If it was 10-15%, the buyer and seller could negotiate. But if it is big numbers and governments are involved, you can't expect that a solution will come in 3 days. So, first part, which you mentioned, we are less affected by this. But yes, because our stock market is a global stock market, we are getting the headwinds of what is happening elsewhere. That is one. Coming to the positives you mentioned, I think you are bang on point. If you see in the last 12 to 13 years, America has consistently been outperforming, and emerging markets, including India, has been consistently underperforming. If you look outside of India, you see China, you see other Asian countries, you see Latin America, you will find that in the last few years, in fact, for the last whole decade, most emerging markets have underperformed America by a mile. The dollar has outperformed all currencies by a mile, and most of these countries have had FII outflows. Sitting in India, we haven't borne the brunt because India is a rank outperformer in the last 4 or 5 years. If you take US dollar terms, second best stock market after America globally is India. So sitting here, barring the last 3 4 months, sitting here, we haven't borne the brunt of America outperforming emerging markets because we were the second best performer, and compared to other emerging markets, we were a massive outperformer, right? But in the last 3 4 months, we got headwinds. Why? Because money went to US, US dollar started appreciating. You know, now with a kind of slowdown being expected in America, you will find that the dollar has been cooling off. The US 10-year is probably what, below 4% now. So that reduces pressure on our currency and reduces pressure on our external macro. It strengthens RBI's hands because RBI's stated intent is to prime our economy by cutting rates and by infusing liquidity. So the collateral benefit to us, if the dollar cools off, if US yields cool off, the collateral benefit to domestic conditions is there. And one of the big collateral benefits, like you rightly pointed out, is also oil prices, and oil prices coming down also is a source of relief. So we have, and even if you look at longer term, the trade related thing. Look, if all these countries are going to get into confrontation with US, and if India actually ends up having a wide-ranging bilateral agreement, ultimately we stand to benefit. We industrialization and getting manufacturing, providing jobs to people. All of these things are priorities for our economy and our government, and I think we will get a positive push if things are done the right way.
Sure. Having said that, is for the investors' point of view, is going to be a very crucial week also because we have the RBI monetary policy coming up, and also we will see a product detailing on the 9th of April. But then, having said that, since we are speaking to a lot of experts throughout the day, and since the entire tariff talk, since 2nd April, everyone has to say it's going to be an accumulation year. You've got to ensure there is stability in your investments. What about from a fund house point of view? I really want to understand, is it going to be an accumulation year for you guys also? What's the kind of strategy that you guys are opting for to mitigate risk? Also, how much are you looking towards the domestic facing sectors, and what is there on your list?
Yes, generally we try to run portfolios which are balanced. After all the international macro and after all the international damage has been already caused, and even the last guy on the street is going to tell you that stay away from IT companies and stay away from pharma companies, and so much of damage is already done now. IT has been underperforming for 3 to 4 years, right? Pharma performed during COVID, outperformed last year, and now it is falling rapidly. So what I'm saying is that to make money, one has to be a bit contrarian. I'm not saying go and buy IT and pharma. What I'm saying is that guys like us, we always run broad-based portfolios. So our deviation sector to sector may not be very, very high actually. Compared to BSE 500, we might be plus minus of sector weights, but our stock picking will be very different. Our portfolio will be 60-70% different from the index, but that is at a stock specific level. When you look at domestic versus exports, defensive versus cyclical, large cap, mid cap, small cap, we might look like we are reasonably balanced because we don't take any macro calls. We only take stock specific bottom up calls. Coming to your other question about accumulation, yes, I completely agree. But I also believe that anybody who persists with their investment in the next 3 to 6 months and who continues their SIPs, keeps investing regularly, I think what will happen is that in the next 2 to 3 years they are very likely to be handsomely rewarded. Because by even before this fall, if you see the large cap space, there was value emerging out of it, right? And now what is happening is broad swaths of the market are following like 5-10% on certain days. So I think that value is coming back in the market. The market is not as expensive as it used to be. In fact, some parts are getting cheaper and cheaper. So people have to be in diversified portfolios. Do not prejudge anything. Like just because somebody says that okay, America is slowing down, IT will do badly. I think that is very surface level observation. I think we have to think a bit longer. So I feel that next 3 to 6 months, people have to keep accumulating in diversified portfolios. I would stick my neck out and say that if we speak 2 years down the line, people who invest in the next 3 to 6 months, they'll be handsomely rewarded because when I have seen in my entire experience that whenever our market takes a beating because of FII selling, because of global concerns, I think with some lag effect, we end up rewarding people very handsomely.
Sure, sure. One more question to you, and this is a very basic question. Something that's maybe on the mind of retail investors, or maybe everyone who wants to invest and make something out of their investments. People who have seen the market in last 2 to 3 years, have heavily depended on growing their savings on the share market. Okay, these are the people who've had aspirations, who had dreams, and just because they are putting money in F&O and they are doing day trading, they have quit their jobs. Maybe they want to buy a car, they want to plan, of buying a dream home for themselves. A lot of them are thinking of switching careers only because they are depending a lot on the share market income. Now, in this kind of a scenario, it is very important for us to help these people understand what can go wrong in their entire financial planning. It is very important for them to understand that this is the time, or maybe this is the entire year when you need to focus on stability and securing the gains that you might have made in all these years. So what should we do? Should we just avoid taking such financial risk? For that matter, even major expense that's coming up, maybe a huge renovation at home that you might want to do and you think that share market can fund you for that, should you stop it?
Okay. So, look, I think 2, 3 things I can suggest out here. Anybody who has goals around the corner, let us say you've been investing for some time, you're sitting on gains. And like Kavita, you just mentioned that, is there a home renovation or something coming up in the near future? So anything where you're going to need money in the near future, then definitely that money you need to take off the table. Because, if you have some big expense coming in the next 2 to 3 months, then you cannot time it to a T. If you have been investing or accumulating money for some time and you're still sitting on some gains, because see, I mean, market is falling, but I think people will be surprised to know we are still at a level higher than end of 23, early 24. Okay, on a 1 year basis, maybe we are flat. But if you see 15 months, 18 months, it's not unlikely that people would have gains. People would have gains actually. Anybody who invested even 18 months or 2 years back would be sitting on some gains. So if you have some kind of goal or some kind of spend coming up, then I think you better plan for it and don't keep waiting for the last moment to arrange or withdraw the funds. Second thing is this is when you mentioned about FNO etc. I think these are the kind of market conditions which are extremely difficult to trade. Extreme volatility. See, when do you see extreme? What is the reason for extreme volatility? Is because extreme volatility actually means that all the millions of market participants and the market in its infinite wisdom all put together, people are not able to get their arms around what this event means and how much damage it can cause. So when people have no clue about what is the impact of a particular event, that is when you have heightened volatility, right? So these are not the kind of times where trading is easy. It's very, very risky, very, very dangerous because there is no direction. Today morning, where the market opened, what happened through the day, and finally where it closed. It closed, I think, near the day's high. But in the first half, it just kept falling. It just kept getting worse, 5% down at a point in time. So these are very risky times to really trade. And any money which you need, you should not be exposing to the market right now. On the other hand, people who are long-term investors, for them, this is a godsend opportunity. I mean, I said it again, I don't mind repeating. In my 25 years, I have noticed time and again, whenever our market falls for reasons which are beyond our borders, and it is largely led by FI selling, I think that is a great opportunity. You will not get a better chance if you're a long-term investor.
All right, so stepping up the SIP should be the strategy, investing lump sum should be the strategy. How can one decide between the two, or both strategies work at this point in time?
I would not tell somebody to jump in lock, stock, and barrel, meaning I wouldn't tell somebody to just because Nifty is fallen or market has fallen, I wouldn't say do lump sum. I feel there is more of this, ups and downs, and I feel there is more of this volatility yet to be coming along. We don't know what all the market has to price in, and we don't know, every day some news to the positive, some news to the negative. Morning it could open up, by afternoon it goes down. So this will persist. So lump sum is not a great way to do it. When I say long-term investors, for them it's a godsend opportunity. I mean that start investing, start deploying. People would get some bonuses and variable pay. This is typically time of the year for a lot of companies following, financial year from April to March. If people come by some money, then they should gradually invest it over the next 6 months. And if you are beginning in the new year with some 8-10% pay hike, then definitely you should step up your SIP also. So I think, increase your exposure. Don't do lump sum. Even if you've got a good bonus or a variable pay, spread it over the next 6 months. I think that will be the way to go. And not no, I don't think there is any train or bus which is going to get missed out in the next 7 days. So don't be in a hurry.
Right, right. All right, strategize your investments, stagger your investment. Thank you so much, Aashish, for being on the show and helping our viewers today. Thank you so much.
Thank you.
Thank you. All right, on that note, let's take a quick break, and post that, let's get connected with Gautam Galia, our expert on the show, who will be doing your life financial planning. And for all the viewers who have any questions, portfolio-related questions, you can WhatsApp your queries on 865-797-4571 and the email ID, themoneyshow@etnow.tv. See you after this break.